Now, chances are you may have seen my video or someone else's video explaining the concept of using a home equity line of credit to paying down a mortgage faster. And in that video, I showed an example of using a $90,000 HELOC against a $100,000 home, or more specifically, getting an 80 to 90% loan to value HELOC on a home. And I've gotten a ton of comments, questions, and skeptics saying that's not possible. There's no way a bank's going to give you, $90,000 against a $100,000 home, or in that ratio, the 80 to 90% loan to value. So today in this video, I'm going to clarify exactly why a bank would give you an 80 to 90% loan to value HELOC, or in a more specific example, maybe a $90,000 HELOC against a $100,000 home in that respective ratio. So let's go and dive right into it as to why that is. So again, I've been getting a ton of comments saying, Sam, your math is wrong. It sounds like a scam. It sounds like a smoke in the mirror. How is it possible that you can get an $80,000 or $90,000 HELOC against a $100,000 home? Now, traditionally, this is true if we're talking about a second lien position HELOC. So let me illustrate this for you using a whiteboard. So in a second lien position HELOC, you're absolutely right. So if we have, let's say, a $100,000 home value, okay, and let's say we already owe, $50,000 on our mortgage. And I'm using this number to just really demonstrate what most people are talking about. So let's say in this situation, 50% of your value, or your home value, is already borrowed as a mortgage. So in this case scenario, we have a 50% loan to value situation. That's how LTV is calculated. Now, most people, when I talk about HELOC, they're thinking about the second lien position HELOC, which would suggest, let's say the bank's going to give you 80% combined loan to value. So 80% combined loan to value. What this means is that the bank is willing to give you up to 80%, a loan amount of up to 80% minus any existing loans or mortgages that exist on the property. So in this scenario, we already have a mortgage of $50,000. This is called first lien mortgage. The whole lesson about lien position, I have a separate video about it, but lien position has to do with which creditor gets paid first in an event of a bankruptcy or foreclosure. Again, I won't go too deep into it, but if you have, like this example, have a $50,000 mortgage against a $100,000 home, you have a first lien $50,000 mortgage. Now, in a second lien position HELOC with an 80% combined loan to value, remember the bank's saying we can only give you up to 80% of the home value, factoring in the mortgage as well. So in that scenario, the bank is only willing to lend up to $30,000 in addition for a HELOC, meaning there's now $80,000 of total debt that this property can have at any given point in time, aka 80% combined loan to value. So when most people point out and saying, well, Sam, you can't get an $80,000 HELOC, how's that possible? Well, in this scenario, you're absolutely correct. That would be true. But in a scenario where we're dealing with a first lien position HELOC, this is what happens. Okay, let me do some erasing here. Okay, same scenario, $100,000 home value, okay? And let's say we were dealing again with the $50,000 mortgage. And in the case where we, let's say, are getting a 80% loan to value first lien position HELOC, this is what happens. You would essentially have this mortgage replaced with an $80,000 HELOC limit, of which out of the $80,000 HELOC limit, because you're replacing the existing mortgage balance, this will be a limit, and you would have $50,000 of balance on the HELOC, on the home equity line of credit. So in this scenario, in a technicality scenario, you would be doing a refinance because you're technically taking a mortgage, paying it off with another type of loan, which in this case would be a home equity line of credit. You'll take a home equity line of credit, pay off the mortgage, and therefore you now have a first lien position home equity line of credit. In other words, your HELOC is the only debt you have against the home. So just imagine, I know some people are like, okay, I still don't get it. Imagine the mortgage just now has a new name and it's called a HELOC. That's it. Okay. It's the same. We didn't incur any additional debt. We didn't incur additional loan. It's the same amount of loan, except the difference is that with a HELOC, we have up to $80,000 that we can borrow at any given point in time. So yes, you have a $50,000 balance, but you can go and write up another $30,000 check if you want out of the home equity line of credit. And of course, we don't, necessarily advise you to do that. But in a scenario of, me using that example in some of the other videos I have, this is exactly what I mean by first lien versus second lien HELOC. I have a separate video of what are the benefits of both and cons. So we'll explain it. But I just want to address this for some of you guys out there thinking, okay, like Sam, that's impossible to get an 80% home equity line of credit when you already have $50,000 in your mortgage or whatever the case might be. So hopefully this video kind of gave you some clarity. And for some of you that are still scratching your head going, wait, there's a thing called first lien HELOC. Where do I get that? Well, that's what we do, Accelerator Banking. We help homeowners get access to first lien HELOC as a process of helping you paying off your mortgage faster. So if you're interested about that, check out some of the links down below in our video description, as well as some of the other videos we have that gives you, our videos give you a really good explanation as to what we do exactly to help you pay off your mortgage faster. So with that being said, be sure to follow us, subscribe to us, like this video, and leave your comments down below. I'm all about helping as many homeowners as possible in achieving financial freedom and peace. So that being said, we'll see you in the next video. Take care.